Hello and welcome to the lecture for Chapter 4. The content of this chapter will allow me to do just one lecture rather than two. So I'll talk about, first of all, the flow of accounting information, so how we go from an adjusted trial balance, which we finished with at the end of Chapter 3, to actually doing financial statements. I'll cover some formatting issues for the financial statements. I'll talk about closing entries, which is the next step after completing financial statements, and then we'll go through the accounting cycle. So the adjusted trial balance flow, all of the information that we need to create financial statements exists on the adjusted trial balance. So all of the revenue and expense line items are going to go directly to the income statement. The owner's capital account, drawing account, and then the net income from the income statement will be used for the statement of owner's equity. And then last, we'll be able to do the balance sheet by looking to the assets and liabilities section of the adjusted trial balance, and then the ending figure from the owner's equity, the statement of owner's equity. So we need to do the financial statements in that order. First income statement, second statement of owner's equity, and then finally balance sheet, because we need information from the previous two to do the next one. So here's a visual depiction of that. In the lower left corner, we have the adjusted trial balance, those final two columns on the right of that end of period spreadsheet. So you can see that debits equal credits are both $43,400. The accounts that they've highlighted in blue are the revenue and expense accounts, starting with fees earned down through miscellaneous expense. That goes to the income statement, which is shown in the lower right corner of this slide. We do that first because we need to know what the net income is, which in this case is $7,105, in order to be able to do the statement of owner's equity, just in the middle here. So in that one, we take the information from the green shaded items here. So the contribution that the owner made and the draw that was made. So that statement is done as follows. That gives us the ending capital balance for this sole proprietorship, $28,105. We need that information to do the balance sheet, which is shown up on the top there. So we have all of the yellow highlighted line items from the adjusted trial balance, all of the assets and liabilities shown on the balance sheet, and then we pull the owner's equity from the statement of owner's equity, and you can see that assets of $29,495 equal liabilities and owner's equity at $29,495 as well. So a little bit about formatting, and everybody kind of agrees to format their financial statements in the same way. This allows there to be more comparability between companies, so that's kind of the primary reason. So in the revenue section, if we just have one type of revenue, we can just use that particular line item. If we have multiple different kinds of revenue, like maybe we have commissions earned and we have rent revenue and interest revenue, if we have multiple different kinds of revenue accounts, then they're going to be shown in descending order. Okay. Expenses are also shown in descending order, so the largest first down to the smallest. Miscellaneous expenses always shown last regardless of the size. And I'll make a little bit of a comment about miscellaneous expense. It's kind of a pet peeve of mine, but I really dislike using miscellaneous expense because it doesn't really convey any information at all to the reader. What is miscellaneous expense? And if it's a large amount, that tells me that you probably should have another expense account and some of that should have been broken out. So if you do use miscellaneous expense, it should be a very, very small number. Subtotals are always shown to the column to the right of the detail. So as you work to the right, you get subtotals, and in each column should stand on its own. When we come to the bottom, we double underline the net income loss. So here's an example of that. So again, the header, the name of the company, second line, what we're looking at, third line, the period of time in question. This is for the 2 months ended December 31st. You can see this company had two different types of revenue, fees earned and rent revenue. So we have in that middle column there, $16,840 and $120. That adds up to the subtotal shown in the far right column. So I have total revenues of $16,960. Notice that the expenses are shown in descending order with miscellaneous expense shown last, even though it's not the smallest. There's an underline under 455 as well as under 120. That signifies that this is the end of this range of numbers, okay? Notice that we only use dollar signs for the first number in a series. So 16,840 has a dollar sign, but 120 doesn't. So too many dollar signs clutter things up and make it more difficult to read. So total expenses of 98.55 and revenue minus expenses is net income of 71.05. The statement of owner's equity is basically, as I mentioned in Chapter 1, a reconciliation of the owner's interest in the business. So we start with the balance in the owner's equity account at the beginning of the period, and then we include what would increase it. So increases would be investments or net income. And then we would record what reduces it, which would be a net loss or draws. And then we double underline. So the final figure on each of these financial statements is always going to have a double underline under it to show this is the end of this statement. So the way this looks, again, proper header there. This is what happened over a period of time. We have their beginning capital balance. This must have been when the business started on November 1st. It was 0. We have an investment which increases. Net income, which came from the income statement, increases this. Withdrawals decrease it. So we have a net increase in owner's equity and then the final balance there. Again, the same kind of pattern exists in terms of dollar signs and underlines that did on the income statement. The last one, balance sheet, we're going to do some subdividing, and some textbooks will call this a classified balance sheet. So we divide the assets up into two categories. Current assets. Current assets are assets that we expect to either be converted to cash or get expensed or used up within 1 year. And it's not within the year that we're working in, it's within the upcoming 12-month window. So it's going to include things like cash, accounts receivable, supplies, prepaid rent. Those kinds of things are all current assets. The other section we'll have is property, plant, and equipment. And we show that net of accumulated depreciation. So that would be the machinery and buildings and land and things like that. We do the same thing on the liability side. We divide it up into two categories. Current liabilities. Those are liabilities that we expect to have to pay within the upcoming 12-month window using current assets. So we don't anticipate rolling the debt over and replacing it with new debt. So those would be things like taxes payable, accounts payable, what we owe our vendors, of course salaries payable, things like that. Those are all bills that are going to come due within the 12-month period. The reason for breaking this out is it gives us the ability to compare current assets to current liabilities to get some insight into whether or not the company is likely to be able to pay their bills as they come due. So we'll also show subtotals to the right of the details the same way. Total assets and total liabilities and owner's equity are both going to be double underlined. So here's an example of that. So again, we have the header there. Key point, notice that the third line of the header is a specific day. So a balance sheet doesn't tell us what happened over a period of time. It tells us the condition of the business at a moment in time. So standing on December 31st, 2018 for this business, this is what they owned, this is what they owed other people, this is what the owner's claim to the business was. So you can see here they've got current assets, cash, accounts receivable, supplies, prepaid insurance. Again, we use the same pattern of the first number having the dollar sign and an underline under the last number there. Property, plant, and equipment, we've got land and office equipment, and notice here we've got a third column because we needed to show the detail to support the net amount for office equipment of $1,750. That represents $1,800 minus the $50 of accumulated depreciation. So, and then down in the liability section, we've got three types of current liabilities: accounts payable, wages payable, and unearned rent. And then we've got the owner's equity. So here we can look at this company and say if they were asking us to extend credit to them, we'd say, well, they've got $7,745 in current assets compared to $1,390 in current liabilities. They're most likely able to pay their bills as they come due. A general rule of thumb, and we'll talk about this more in Accounting 202, is that you want the current assets to be at least double the level of current liabilities in order to feel comfortable about getting paid. If that makes sense. So the next thing I want to talk about is a closing process. So we've done the financial statements, that's done for the end of the year, and now we want to get the books ready to start transactions in the new year. So we need to think about accounts in two categories. One would be permanent accounts. Those are accounts where the balances are carried forward from year to year. So if we have a truck at the end of this year, we still have the truck in January. If we have a building this year, we still have the building next year. If we have long-term debt December 31st, that long-term debt is still there January 1st. So those are permanent accounts. They don't have to be closed out. Temporary accounts are income statement accounts, and those get closed out to the owner's capital account at the end of each year. Think of it as kind of wiping the slate clean so we have a fresh start to the next year. If I'm paying $1,000 a month in rent, then I need to know as I'm going through the year what my rent expense is for the month and what the rent expense is year to date. So in June, as an example, I have $1,000 of rent expense for the month, and I have $6,000 in year-to-date rent expense. Well, that year-to-date rent expense needs to be zeroed out at December 31st because I want to start fresh on January, right? So we'll do the closing entry to bring the balances of temporary accounts to zero. So that closing entry is going to be comprised of two entries. The first entry is to close all of the revenue and expense accounts to the capital account. So revenue accounts have a normal credit balance, so we need to debit those accounts to zero them out for their balance. Expense accounts have a normal debit balance, so we have to credit them to zero them out. And the difference between those two is going to go to the owner's capital account. And I'll show you an example of that in a minute. The second closing entry is to close the owner's drawing account. That's the one non-income statement account that is also temporary. So we close that out to zero it out as well. So here's an example from a T account standpoint. So in the upper right corner there, I've got two revenue accounts. They had credit balances, where the word balance that's on the right side, that's the credit side. So we needed to debit those accounts. So we debit that. And then all of the expense accounts had debit balances, and we needed to credit those accounts. So that's the net difference between those two will be 7105, which should be a familiar number from these examples, which is the net income for the company. And then we close out the drawing account. So that's a depiction from a T account standpoint. So the way it looks from a journal entry standpoint is here I'm debiting the two revenue accounts, that will zero them out, and I'm crediting all the expense accounts, which will zero them out. The difference between debits and credits will be a credit to Chris Clark Capital. So that increases the owner's capital, which we know net income brings up the owner's capital account. And then we close out the drawing account. It has a normal debit balance, so we credit it, and we reduce the owner's capital account by debiting it. So the last thing I want to talk about is the accounting cycle. So all the steps that we've been through, because I've just shown you the last step now. So the first step is transactions occur in the business. We analyze those transactions. We record them in a journal. So we're capturing and recording transactions as they occur. Once they're recorded in the journal, we post them to the general ledger. I remember talking to you about that is kind of like a binder with one page for each account. We're recording that to each of those pages in effect. When we're done with a particular period, let's call it when we're done with the year, maybe, we prepare an unadjusted trial balance to make sure we don't have any mistakes, that debits equal credits, that nothing looks funky. If anything is wrong, we do correcting entries to fix it. And then we look for adjustment data. So how much of our supplies did we use up? Did we get any money from people that have we done some of that work for them and we can reduce that liability? Is there any work we've done for people that we haven't billed them for yet that's not reflected in our financial statements? So you can skip number 5. So then we'll do adjusting journal entries and post those to the ledger. And we'll prepare an adjusted trial balance, making sure that we haven't added any mistakes, that things still look good. If everything looks good, then we'll use that adjusted trial balance to prepare financial statements. When those are done, we'll do the closing entries, and then the last step is to make a post-closing trial balance, which should just be our balance sheet accounts. It will only reflect our permanent accounts. All of the revenue expense accounts and the drawing account should be zero. So hopefully that is helpful to you, and if you have any questions, please don't hesitate to email me, and I look forward to talking to you when we get into Chapter 6. Thank you.